Good afternoon from Tampa, Florida, everybody. Thanks for joining the Lineberg webinar here about the New York Best Interest Rule for life insurance, new requirements for producers, and ethical considerations for other estate planners. This webinar is an overview of a commentary that I wrote for the Lineberg Financial Products Planning email newsletter, archive message number 6. That should be uploaded to the handouts section of your GoToWebinar window while we're talking, and if not, it'll be included in the follow-up email. Many of you may already have it or have read it, but you should have it while we're talking here and or in the follow-up email regardless. The New York Best Interest Rule was issued by the New York Department of Financial Services July of last year, and it's actually a rule that covers both annuities and life insurance. We're only going to talk about the life insurance part. We're going to talk about it both from the perspective of the new requirements for what the reg defines as life insurance producers. Agents and brokers are termed producers under the reg. And we'll talk about what Marty Shankman and I talked about in a video that he did, in an interview that we did at Heckerling, the ethical considerations for other estate planners, certainly for attorneys, for CLUs and CHFCs, AEPs, CFPs, really anybody with a fiduciary duty who's in the estate planning business. I think this reg, and Marty and I discussed how this reg raises questions at least. So let's think it through by way of analogy. Let's think through this before I get into the new requirements. Let's think through the question, the ethical questions, the ethical implications by analogy. If we had a client, if a client came to us and asked for advice about asset protection, then certainly there'd be some duty to advise that client about the statutory protections, income tax advantages, voidable transaction rules in states like Nevada, South Dakota, Ohio, etc. Likewise, if we were doing an estate plan and the estate plan involved a dynasty trust, for instance, then again, I don't think anybody would argue that there'd be some duty to have a conversation about the different perpetuity statutes and the different rules against perpetuities and the different income tax treatment and spendthrift provisions in the different states like South Dakota and Nevada and Tennessee, etc. So if it is part of our advice, either as a matter of best practices or as a matter of an ethical duty, to talk about the different rules in different states for asset protection trusts and dynasty trusts, does the New York interest rule, do these new regs present a similar question about a similar duty or best practice around life insurance trusts? Should life insurance trusts be domiciled in New York because of this new New York rule? The New York rule, this New York Best Interest Rule, Reg 187, defines for the first time clients' best interest for product recommendations like other fiduciary rules. It requires that product recommendations consider only the interest of the consumer when making a product recommendation, requires that the recommendation reflect the care, skill, prudence, and diligence of a prudent person, and it requires that insurance producers prominently disclose in writing the range or the limitations of the range of policies recommended. It also requires that recommendations be based on evaluation of things that most of us are familiar with from work on virtually any other asset on the client's balance sheets, but different from recommendations in the past about life insurance, as we'll see. But the New York Best Interest Rule requires recommendations to be based on all products and services available to the producer, relevant suitability information, which is defined in the regs, which again is very similar to other fiduciary rules, and based on the evaluation of costs that can be justified, performance that is reasonable to expect, and risk that is appropriate to the client or to the situation, risk tolerance. Some may be saying, well, what's the difference about this new rule versus the way insurance recommendations have been made in the past? Haven't life insurance product recommendations always considered these things? Well, I'm going to answer that in a minute, but as it relates to our first question, should ILETs be domiciled in New York? We need to keep in mind that the Reg 187 applies to residents of New York. Even if the advisors are in another state, it applies to residents of New York. It applies to former residents who have ILETs domiciled in New York. It applies to ILET trustees in New York, even if the ILET is domiciled elsewhere, and it applies to financial advisors in New York or who work with clients in New York. But if you're outside of New York, this rule doesn't apply. And if it doesn't apply, if it doesn't apply to somebody outside of New York, then we come back to that question: should the ILET be domiciled in New York, or maybe some other things to think about, which we'll talk about at the end. So how is the New York Best Interest Rule, Reg 187, different? Well, prior to the New York Best Interest Rule, and in states outside of New York, or residents outside of New York who don't have an ILET in New York or who don't work with a financial advisor in New York, best interest was previously defined under the, at least for product recommendations, by the National Association of Insurance Commissioner, or NAIC, Illustrations Model Regulation. This regulation was, the model was issued on or about in 1985. It was started to be adopted, I believe, in 96, 97, state by state. The goals of the Illustrations Model Regulation was to make illustrations, make sure they do not mislead purchasers, and to make them more understandable. And whenever I'm in front of a live audience, I'll ask for a show of hands to see how many in the audience might or feel as though illustrations are understandable and not misleading, and I don't get anybody typically raising their hands. And in fact, the National Association of Insurance Commissioners concluded 20 years later, in an update called Actuarial Guidance 49, or AG 49, they concluded that the Illustrations Model Regulation resulted in a lack of uniform practice, where illustrations appeared to use an identical crediting rate, yet actually used different, and in some cases significantly different, rates when they were calculating hypothetical policy values. And we're actually going to look at a real life example of that. In addition to the NAIC concluding that the Illustrations Model Regulation results in apples versus oranges comparisons by their own finding, the the Illustrations Model Regulation doesn't even require disclosure of cost, performance, and risk, which is required by the New York best interest rule. And frankly, it is a fundamental requirement of any fiduciary rule. ERISA, the Uniform Prudent Investor Act, they all require disclosure of and consideration of costs separate from performance, and then separate from the consideration of the risk that the expected performance won't be achieved. For these reasons, the chief regulatory body of the financial services industry, FINRA, Financial Industry Regulatory Authority, issued a rule, Rule 2210, saying that it is inappropriate to compare a life insurance policy with another product based on hypothetical performance, because if you're not looking at the very same things that we just talked about, if you're not looking at cost, performance, and risk, then that comparison would be misleading. In addition, the Society of Actuaries, the chief actuarial body for the life insurance industry, issued a study, commissioned a study, concluding, among other things, that illustrations should not be used to compare policy performance or to compare which policy is better than another based on performance, because doing so would be not just inappropriate, but would be fundamentally inappropriate. And lastly, the chief regulator for institutional fiduciaries, the OCC, updated their handbook for unique and hard to value assets and cautioned their fiduciaries that these policy illustrations are subject to a high degree of fluctuation and therefore clearly not reliable for comparison purposes and for product due diligence, for product recommendations and decision support, what FINRA and the Society of Actuaries and what the OCC concluded is little different than what probably most everybody, if not everybody on this call, already knows. We can see that not only was our intuition maybe right, but the New York regs are considerably different than the rule governing product recommendations prior to the New York regs and outside of New York. So, as I mentioned at the beginning, our conversation here today is a summary or an overview of the commentary I wrote for the Financial Products Planning newsletter. In that commentary, I walked through in considerable detail a real-life example using real-life illustrations of the differences between New York Best Interest Rule 187 versus the NAIC Illustrations Model Regulation. But at a high level, and for anybody who has that newsletter, by the way, I do see that it has been uploaded to the GoToWebinar portal. So if you don't already have it in front of you, you can download it. If you can get it downloaded and open up to page 5, you'll see where I talk about the common practice of, you have a client. I talk about a 45-year-old client in my commentary in the Lizzie newsletter, and we're doing an estate plan, and we need $1 million of life insurance. So we request from our trusted insurance broker or agent, or if we're in the insurance business, the BGA that we work with or the IMO that we work with, we request apples to apples illustrations for the best products that they would recommend. And then on page 7, we look at what the New York Best Interest Rule requires you to look at. And in summary, the practice of asking for supposed apples to apples illustrations, where we make sure the age is the same and the risk class is the same and the face amount is the same and the gender is the same and the rate of return, the assumed rate of return is the same, and we do all that we can to make it apples to apples, so that we can use the illustration as a proxy for cost, for which policy has the lowest cost. Because if everything else is the same, if everything is the same except cost, then the policy with the lowest premium would have the lowest cost, right? Stands to reason. So in my LISI commentary, we talk about an indexed universal life product that has a $13,000 premium and a universal life product that has an $8,500 premium. So it's not even there's no contest here. The universal life product, if everything is equal, if age, gender, space amount, risk class, rate of return, if everything is equal, then this universal life product here, this actual product, which I don't actually name, but this actual product here has to have lower costs, right? Well, if you look at page 7 of the LISI commentary, you'll see that the costs in the indexed universal life product are to maturity are about a little over $800,000. So the cost of the UL product have to be less than $800,000, right? But you'll see on page 7, or it might be page 8 of the LISI commentary, that the costs are fully 30%, more than 30% higher than the costs of the indexed universal life product. So how is it possible that for 2 illustrations that we've made every effort to make sure that they are apples to apples, how can the premium of one be lower but the cost be 30% higher? Well, that's also answered in the LISI, in my LISI commentary. For those of you who have looked at it or who are following along, the illustrations were requested using a 5% interest rate. So on the universal life policy, the cash values at a point in time, I think it was 20 years, the cash values at 20, I think 25 years were are projected to be $100,000. So this is simple math. The interest on the interest at 5% on $100,000 is $5,000. And for those who are following along, I know that the cash values in the illustration in the LISI commentary is actually like $110,000, but from that would be deducted costs for that year before interest is credited. Costs are about $9,000, almost $10,000. So the cash value or the account value on which interest would be credited would be $100,000. 5% of $100,000 is 5%. Simple, right? But for those who are following along, you'll see that the interest actually credited in that year, in the 25th policy year, the interest actually shown or assumed to be credited in the illustration is $14,000. Almost 3 times as much as would be reasonable to expect based on the fact that above every column of hypothetical policy values, it says prominently using a non-guaranteed interest rate of 5% or based on calculations of current charges and 5%. So any reasonable person would look at the illustrations where it's prominently displayed, where the interest rate prominently displayed is 5%. It would assume that a reasonable person would assume that all the hypothetical calculations, the premium calculations, the cash value calculations would all be done at 5%. Yet we see here that the actual interest is 14%. In other words, for this policy to work as expected, this universal life policy would have to earn 14% on average, year in, year out, without interruption, in order for the UL policy to have an $8,500 premium. Now, by the way, I'm not saying that this insurance company can't get a 14% rate of return. I'm certainly not saying that they can, but I'm not saying that they can't. I'm just saying that under the NAIC illustrations model regulation, this is permissible. Whereas under the New York best interest rule, you can't compare illustrations, probably partly for this reason here. You can't compare illustrations, at least not as a practical matter, because the hypothetical comparisons don't give you the information that the New York best interest rule requires. The New York best interest rule requires that you look at the actual costs and look at the actual performance that is expected, or in this case, required to make the product work as expected. And not to pick on the UL product provider here, the index provider has got similar shenanigans going on. This is a relatively common practice nowadays. Didn't used to be so common, although comparing illustrations never made sense to me, but didn't used to be so common. But now the largest selling product, according to LIMRA, an industry association that tracks product sales, the best selling product is indexed universal life, and something like 70% of all indexed universal life products have this type of undisclosed or underdisclosed bonus interest credits. And as we see here, some universal life products also have it. And we'll talk a little bit more about that in a few minutes. So for these reasons, comparing hypothetical illustrations never made any sense to me. I started my career, I actually grew up in the financial services business. I'm the son of an actuary. By virtue of this apple not falling too far from the tree that was my dad, I became the youngest CFP in the history of the College of Financial Planning. At least at that time. Some other youngster has beat me out now. But I started my career as an analyst in a pension investment advisory department of the firm that my father had started. He wouldn't let me work for him. I went to go work for another actuary who ran the pension investment advisory department. And my job was to take the statements that the partners in the firm came back from meetings with. And my job was to use Morningstar to look the funds up in Morningstar, to look at the fees, to examine the fees being charged in the pension or profit sharing plan, to look at the performance of the funds in the pension or profit sharing plan. And that experience of using Morningstar just made a whole lot of sense to me, that benchmarking costs and performance against the universe of peer group alternatives certainly made sense to me at the time. And then when I graduated college and took a position in a life insurance agency, again as an analyst, supposedly doing similar duties, looking at products and trying to do due diligence to support product recommendations. That experience could not have been further from my experience in the pension investment advisory department, where I was using Morningstar and benchmarks for costs and the reasonableness of performance. Instead, I'm comparing, one illustration piece of paper that's not going to come true to another illustration piece of paper that's not going to come true, and that was due diligence, and that never made any sense to me. So from those days, I spent what I guess has now been the past 30 years trying to find or develop eventually ways for advisors to benchmark costs and benchmark performance in the same way that it was easy for this 19-year-old kid at the time to benchmark mutual fund costs and performance using Morningstar. From that experience, from these two different experiences, from this experience starting in the fiduciary environment, moving on to the life insurance world, being frustrated by illustrations, comparisons that never made any sense to me, finding and eventually inventing software that allows any financial advisor to very quickly and easily benchmark cost and performance of life insurance against the universe of peer group alternatives, from all of that experience, if I do actually, I was going to say if I was serving as fiduciary, and I actually do serve as a fiduciary on several thousand irrevocable life insurance trusts, I tell my trustees, do not have an illustration comparison in the trust file for a reason we'll discuss in a minute. Instead, insist, illustrations do contain important information. The illustrations don't always include this important information, but if you request it, they will. Insist that illustrations include the pages that are commonly referred to as detailed expense pages. And for those who are following along in my LISI commentary, examples of those detailed expense pages, they're also commonly referred to as policy accounting pages. Examples of that are shown in figures 1 through 4. And for those who aren't following along, what detailed expense pages are or policy accounting pages are the pages that show year-by-year disclosure of cost of insurance charges and other policy expenses like premium loads, fixed administration expenses, wrap fees like M&Es on VUL products. But if, as we saw from our earlier example, if you're simply comparing hypothetical premiums or hypothetical cash values, you have no chance of determining in any fiduciary way which product is in your client's best interest. If you get the detailed expense pages, you at least have a chance. At a minimum, compare the costs and performance, costs separate from performance, using these detailed expense pages. And my LISI commentary includes 12 pages of explanation for how I would do it if I were doing it by hand, or how Veralytic does it in a matter of minutes. Full disclosure of all the methodologies in the LISI commentary. It's also part of the user guide of every Veralytic report. And using a Veralytic report or benchmarking by hand using the instructions on LISI pages 13 through 25, benchmarking is certainly more well established in the fiduciary space, and much more common when you're talking to any other financial advisor for any other asset on the client's balance sheet. The way Veralytic does it, if you were to get a Veralytic report, Veralytic actually benchmarks 5 things. I'm going to talk about one of them here. We benchmark or measure financial strength and claims paying ability, cost competitiveness, which I'm going to come back to, the stability of the carrier's pricing representations, the ability to access cash values or not, and the one that is so inexplicable to me in these hypothetical illustration comparisons, we actually look at the actual historical performance of invested assets underlying cash values. Not that past performance is any guarantee of future results, but if somebody has been able to do something in the past, it's reasonable to think that they've got a better probability of being able to do at least that thing again, versus these hypothetical illustrations where the illustrated crediting rates, the assumed crediting rates, are oftentimes not based in any historic, or not connected to any historical performance. So looking at the way, for instance, Veralytic benchmarks costs, since the New York regs require insurance producers and provide a guide for estate planners to instead of illustration comparisons, look at costs. The way Veralytic does that is we calculate the average cost of everything in our database. So we create a benchmark from which we can also calculate the variance, which is as much as 80% between worst available rates and terms and best available rates and terms. And once we know where the average is, and once we know the variance between the worst rates and terms and the best rates and terms, we then can measure the costs for the product under evaluation or the costs for any recommended product against that benchmark, and we know whether or not the product, the in-force policy or the product being recommended is in the range of best available rates and terms. So if you're an estate planner who's not in the insurance business, this is good documentation for a fiduciary file. Certainly better documentation than hypothetical illustration comparisons considered misleading, fundamentally inappropriate, and unreliable. And if you're a producer in New York, the Fair Lake Report would arguably document your investigation of costs for under the New York Best Interest Rule and justify. The New York Best Interest Rule allows for commissions, but it says that commissions need to be justified. So if you're bringing clients, if you're recommending to clients or clients' advisors or to a ILIT trustee a policy that has among the lowest costs in the industry, then the New York Best Interest Rule says that it is perfectly appropriate and, in fact, appropriate to receive a commission. So the New York Best Interest Rule talks about justifying costs. It also talks about the reasonableness of performance expectations. So let's look at how benchmarks are commonly used to set performance expectations for every other asset on the client's balance sheet, every other asset in the financial services business, and then we'll relate it to life insurance. So regardless of what some illustration may say or not say, as we talked about a few minutes ago, the rate of return that the client will actually get from any financial instrument is going to be predominantly a function of their risk tolerance. And then the asset allocation that correlates to that risk tolerance or that investor temperament, the time horizon over which we can allow volatility to work itself out or not, and then the rate of return that is reasonable to expect, considering risk tolerance, asset allocation, and the amount of time we have. So if we apply that to life insurance, irrespective of what some illustration may say, universal life and whole life products have to, as a practical matter, by regulation, they have to invest predominantly in high-grade bonds and government-backed mortgages. Well, what have high-grade bonds and government-backed mortgages averaged over the last 5 decades, including low interest rate periods like we have now and high interest rate periods like the 1980s? Well, fixed income instruments like high-grade bonds and government-backed mortgages have averaged between 5 and 6%. So it is reasonable to expect a whole life or universal life product to average the dividend interest crediting rate or the interest crediting rate to average 5 or 6% over time. And the inverse, I would say that I would need anyway, certainly if I'm in a fiduciary capacity, some explanation for why a whole life or universal life product is being illustrated at higher than 5 or 6% over the long term. Similarly, for clients that have a moderate conservative investor temperament, indexed universal life is a universal life product. Its cash values are required by regulation to invest in high-grade bonds and government-backed mortgages. Only the earnings from that portfolio of high-grade bonds and government-backed mortgages can be invested in an index. And since a part of the performance can be attributed to an index, then it is reasonable to expect that there would be some lift above the fixed income return that could be achieved from an indexed universal life product. But some caution is needed there. Indexed universal life products invest in an index. They invest in an index by virtue of options, whenever you are buying options on an index, you do not get the dividends from the stocks in that index. Dividends comprise 20 to 40% of the total return of, for instance, the S&P 500 index. So you're going to get some lift from participation in the equity index, the equity element of the index, but you're not going to get full participation in, for instance, the S&P 500 because you don't get dividends. And so the lift that at least Veralytic thinks, that I think, is it's reasonable to expect a 6 to 7% rate of return over the long term out of an index product. And conversely, I would need, if I was sitting next to a fiduciary or advising a fiduciary, I would need some explanation for why an illustration would assume or would calculate premiums or would calculate cash values using a rate of return higher than 6 or 7%. And we're going to talk about that more in the next slide as well. And then similarly, if you've got an aggressive a client with an aggressive investor temperament or risk profile, and they're okay with volatility, they're okay with getting statements that show the cash values being down, which would never happen with or far less frequently happens with a universal life or a whole life, or they get a premium call, or they're told, performance is down, we need to throw some more money in. If they're okay with that, then a variable universal life policy would certainly be appropriate. And historical performance of equity asset classes would support a return of 9 or 10%. But caution needs be taken here too, because that volatility can have an adverse impact on actual performance, where these illustrations calculate linear performance. They assume 9 or 10% every single year. They don't factor in that during a crash, when the market is down and unit values are down, those cost of insurance charges still need to be paid. And so the insurance company has to redeem more units because they're worth less. When the market's down, they redeem more units to pay the cost of insurance charge. And then when the market recovers, there are less units because the insurance company had to redeem more of them to pay cost of insurance charges. There are less units to then appreciate back up when the market rises. And so if you, in the circumstances where you've got downward market corrections, that will, even if the average rate of return of the funds is 9 or 10%, the average rate of return for the policy will be less than 9% in that situation. So caution needs to be taken there. There are some there is some Monte Carlo software out there that can help measure the risk of a premium call associated with that market volatility, which I would recommend if you're looking at variable type products. So looking at the rate of return that's reasonable to expect from asset class benchmarks is again different from comparing hypothetical illustrations, in that here's a Veralytic report for a indexed universal life product, and the rate of return that that is shown prominently at the top of the illustrations is 6.09%. So one might think, well, it's an indexed universal life policy. I listened to this guy named Flagg on a Lineberg webinar who said that a 6 to 7% rate of return from an index product is not unreasonable to expect. So maybe I'm okay here. However, if you didn't look at the detailed expense pages like we did earlier, in the earlier example, or if you didn't get a Veralytic report that shows that there is a undisclosed or underdisclosed bonus interest crediting rate of 4.61%, and that the actual rate of return used to calculate hypothetical premiums and hypothetical cash values is 10.7%, then you wouldn't know that there is the risk inherent in a 10% return. There is additional risk in this illustration that is not apparent from the prominently displayed 6.09% rate of return at the top of all the columns of hypothetical policy values. So again, another difference for another difference between the fiduciary or fiduciary-like practices required under the New York Best Interest Rule versus the illustration comparisons and what is allowed under the National Association of Insurance Commissioners illustrations model regulation. So for all these reasons, if illustration comparisons are misleading and fundamentally inappropriate and unreliable according to financial, insurance, and banking industry authorities, then illustration comparisons are certainly inconsistent with a fiduciary's duty to exercise reasonable care, skill, and caution. And under the New York reg, care, skill, caution, and diligence. Whereas benchmarking, as we've shown, is benchmarking costs separate from performance is consistent with the New York reg. It's also, Veralytic reports are also reviewed by FINRA and found to be consistent with their requirements for fair and adequate disclosure. That FINRA Rule 2210, where it says that if you're not looking at costs and performance, which is what Veralytic does, then the analysis or the comparison is misleading. And benchmarking costs separate from performance, whether you do it by hand using the direction in my Lizzie commentary, or whether you do it by using Veralytic, it is well established, common, and proven, and therefore brings us back to our questions that if the New York reg requires these things that are common and proven and consistent with fiduciary practices and FINRA rules, as estate planners, particularly as fiduciary estate planners, should we be domiciling ILETs in New York? Or should we at least be making sure clients talk to life insurance producers who are licensed in New York and required to be familiar with these practices? Or at a minimum, should we be advising clients that there is this regulatory protection in New York in the same way that if a client comes to us seeking advice about asset protection, we're going to tell them about the states that offer the best statutory protection and the best environments for asset protection trusts. If we're doing an estate plan that includes a dynasty trust, we are certainly going to talk with the client about and advise them about the jurisdictions that offer the best provisions for rules against perpetuities and having a dynasty trust. So do estate planners have some type of ethical duty or some duty of some sort to advise clients about New York as a jurisdiction for an ILET that includes protections not available in other states? I don't know. I'm not an attorney, but I have been in the fiduciary world all of my career and do know that the New York Best Interest Rule prescribes, for the first time, due diligence for product recommendations that is consistent with other fiduciary rules, and is worthy of, certainly if you're in New York, you're required to know about it soon by February of 2020, and if you're not in New York, if you're an insurance producer not in New York, but you might have clients in New York, you'd want to know about it. And even if you're an estate planner who's not in the insurance business, it seems to me that if we're gonna even if it's just as a matter of best practices, talk about Nevada and South Dakota for asset protection trust and dynasty trust, we ought to be talking about New York as a jurisdiction for ILITs. So with that, let's see. I see a couple of questions here. Two questions from Richard Freeman. Hey, Richard. How are insurance carriers responding to this new reg? I don't know that yet. They have not. I've seen insurance carriers issue notices that this new rule is coming and that they're working on policies and procedures, but I haven't seen any of the policy procedures yet. And then your other question was bonus rate plug computation. If you can give me some more detail on that in the questions box, I'll try to answer it, or you can send me an email and I'm happy to answer that one, or call me. I'm happy to answer that one offline. In the meantime, does anybody else have any questions? You can enter them into, there's a questions box in the GoToWebinar panel. So Richard got back to me. So yes, on the Veralytic reports, the bonus rate, we calculate what the bonus rate is from the insurance company illustration. So the insurance company illustration is still the source document. The insurance company illustration either doesn't disclose at all or discloses in the proverbial fine print on page 50 of the illustration what the bonus rate is. But the Veralytic report on the main page, on the main analysis page, where all the information about the policy is found, on that part of the report that I blew up on the screen, the Veralytic report calculates what the bonus rate is from the insurance company's source document and displays it on that analysis page, so it's easy to find. So I don't see any other questions. We have certainly covered a lot of material here. If anybody else has any other questions, feel free to email me at bflag, that's B for Barry, flag with 2 G's, F-L-A-G-G, at veralytic.com. Sorry, I didn't actually put that onto the Q&A slide. Feel free to also follow me on LinkedIn or Twitter. I post to Twitter mostly for media coverage, but if you have a Twitter account, please follow me. I'm trying to build up that presence. On LinkedIn, I already have I have a lot more followers on LinkedIn, and I post most everything to both places, and you can ask me questions there certainly too. Lastly, thank you everybody for attending. I want to also certainly thank Lineberg Information Services Inc. for the privilege of publishing the paper that I wrote and the opportunity to talk about it here. Thank you, Richard, for keep up the good work. I will do just that. And unless anybody else has any other final questions, that'll wrap it up for today.